Hey, what's up everybody? It's Rents Mar here, and welcome back to the channel where we help you make smarter financial decisions and build long-term wealth. Now, when it comes to investing, it's not about getting rich quick. Trust me, I've been there, done that, and it's not all it's cracked up to be. What we're focused on is steady growth over time. That's how you build real, lasting wealth. So in this video, I'm going to be sharing some smart investing tips that can help you do just that. Make sure to hit that like button and subscribe so you don't miss out on future videos. Before you even think about buying a single stock, bond, or rental property, you need a plan. This plan is your investment blueprint, a detailed guide that will help you navigate the complex world of investing. Without it, you might find yourself lost, making decisions based on emotions rather than logic and strategy. It doesn't have to be anything crazy complicated, but you need a roadmap. This roadmap will outline your financial goals, the steps you need to take to achieve them, and the timeline for each step. Think of it as your personal GPS for financial success. It will keep you on track and help you avoid detours that could cost you time and money. Think of it like building a house. You wouldn't just start laying bricks without a blueprint, right? The same principle applies to investing. You need a clear plan to guide your actions and decisions. This blueprint will help you understand the different types of investments available, how they work, and how they can help you achieve your financial goals. Same goes for your investments. Without a plan, you might end up investing in things that don't align with your goals or risk tolerance. A well-thought-out investment blueprint will help you make informed decisions and stay focused on your long-term objectives. First things first, figure out your financial goals. What do you want to achieve with your investments? Are you looking to build wealth over the long term, or do you have specific short-term goals in mind? Your goals will determine the types of investments that are right for you. Are you saving for retirement? This is one of the most common financial goals, and it requires careful planning and a long-term perspective. You'll need to consider factors like your desired retirement age, lifestyle, and the amount of money you'll need to support yourself in retirement. A down payment on a house? Your dream car? These are more short-term goals that might require a different investment strategy. You'll need to think about how much money you need to save, how quickly you need to save it, and the best way to invest your money to achieve these goals. Once you know your destination, you can figure out how much you need to invest and what kind of return you need to get there. This will help you determine the types of investments that are right for you and the level of risk you're willing to take on. This is where things get really interesting because your risk tolerance comes into play. Some people are comfortable with a high level of risk, while others prefer to play it safe. Your risk tolerance will determine the types of investments that are right for you and the level of risk you're willing to take on. Are you comfortable with a little volatility, or do you prefer to play it safe? Understanding your risk tolerance is crucial because it will help you choose investments that align with your comfort level and financial goals. If you're not sure about your risk tolerance, consider talking to a financial advisor who can help you assess your risk profile and make informed decisions. This will determine what kind of assets you should be investing in. Stocks, bonds, real estate, mutual funds, and other investment vehicles all come with different levels of risk and potential returns. Your investment blueprint will help you understand these options and choose the ones that are right for you. Remember, this is your money, your future, so take the time to create a plan that makes sense for you. A well-thought-out investment blueprint will help you stay focused on your goals, make informed decisions, and ultimately achieve financial success. So take the time to create your investment blueprint today and start building the future you want. You've probably heard the saying, "Don't put all your eggs in one basket." This age-old adage is more than just a piece of common wisdom. It's a fundamental principle in the world of investing. The idea is simple, yet profound. By spreading your investments across various assets, you reduce the risk of losing everything if one investment fails. Imagine if all your eggs were in one basket and you dropped it. You'd lose all your eggs in one go. The same concept applies to your investments. Well, in the investing world, that's basically rule number one. Diversification is not just a strategy. It's a necessity. It's about balancing your portfolio in such a way that the performance of one asset doesn't overly impact your overall financial health. This is why financial advisors always emphasize the importance of diversification. They know that a well-diversified portfolio can help mitigate risks and enhance returns over time. Diversification is key to managing risk. By investing in a variety of assets, you can protect yourself from the volatility of the market. For instance, if the stock market takes a downturn, your investments in bonds or real estate might still perform well, balancing out the losses. This way, you're not putting all your financial hopes on a single investment. Think about it. If you invest all your money in a single stock and that company goes belly up, you're in trouble. It's a risky move that could lead to significant financial loss. On the other hand, if you have a diversified portfolio, the poor performance of one stock won't be as devastating. You'll have other investments that can help cushion the blow and keep your financial goals on track. But if you spread your investments across different asset classes, stocks, bonds, real estate, maybe even some crypto if you're feeling adventurous, you're much better protected. Each asset class has its own risk and return characteristics, and they often perform differently under the same market conditions. By diversifying, you can take advantage of these differences to create a more stable and resilient portfolio. Within each asset class, you can diversify even further. For example, within stocks, you can invest in different sectors such as technology, healthcare, and consumer goods. This way, if one sector underperforms, the others might still do well, balancing out your overall returns. The goal is to spread your investments in such a way that you're not overly exposed to the risks of any single sector or asset. Don't just invest in one industry or sector. Spread it around. By doing so, you can take advantage of the growth potential in different areas of the economy. For instance, while the technology sector might be booming, the healthcare sector could provide stability and consistent returns. A diversified portfolio allows you to benefit from the strengths of various sectors while minimizing the impact of any single sector's downturn. The idea is to create a portfolio that can weather market storms. Markets are inherently unpredictable, and no one can accurately predict their movements all the time. By diversifying, you're building a financial safety net that can help you navigate through the ups and downs of the market. This approach not only helps in managing risks, but also in achieving more consistent returns over the long term. Because let's be real, the market is going to go up, it's going to go down, and sometimes it's going to feel like it's on a roller coaster. The key is to stay calm and stick to your diversified investment strategy. Over time, this approach can help you ride out the market's volatility and come out ahead. Remember, investing is a marathon, not a sprint. Patience and discipline are crucial. Diversification helps you ride out those ups and downs and come out ahead in the long run. By spreading your investments across different assets and sectors, you're not only managing risks, but also positioning yourself for potential growth. It's about creating a balanced and resilient portfolio that can help you achieve your financial goals no matter what the market throws your way. So, remember to diversify and invest wisely. Now, I know what you're thinking. The market can be intimidating. The constant ups and downs, the unpredictable nature of stock prices, and the overwhelming amount of information can make anyone feel uneasy. It's easy to get caught up in the fear of making the wrong move or missing out on a great opportunity. Trying to time it perfectly and buy low, sell high, it's a strategy that sounds great in theory, but is incredibly difficult to execute in practice. Even seasoned investors struggle with predicting market movements accurately. That's enough to make anyone's head spin. The stress and anxiety of constantly monitoring the market can take a toll on your mental health and overall well-being. It's no wonder many people feel overwhelmed and unsure about investing. But here's the thing. You don't have to be a market timing genius to be a successful investor. In fact, some of the most successful investors focus on long-term strategies rather than short-term gains. They understand that the market will have its ups and downs, but over time, it tends to grow. In fact, trying to time the market can actually hurt you more than it helps. Studies have shown that investors who try to time the market often end up buying high and selling low, which is the exact opposite of what they intend to do. That's where dollar cost averaging comes in. This strategy allows you to invest consistently over time, regardless of market conditions. By doing so, you can avoid the pitfalls of trying to time the market and reduce the impact of volatility on your investments. It's a simple strategy that takes the emotion out of investing. By committing to invest a fixed amount regularly, you can stay disciplined and avoid making impulsive decisions based on market fluctuations. Instead of trying to invest a lump sum all at once, you invest a fixed amount of money at regular intervals, regardless of the market price. This means you're buying shares consistently, whether the market is up or down. So, when the market is down, you're buying more shares at a lower price. This can be beneficial because you're getting more value for your money during market dips. When the market is up, you're buying fewer shares at a higher price. While this might seem less advantageous, it balances out over time because you're not putting all your money in at once. Over time, this strategy can help you average out the cost of your investments and potentially reduce your risk. By spreading your investments over a period, you can smooth out the highs and lows of the market, leading to a more stable and predictable investment journey. Dollar cost averaging is a powerful tool that can help you build wealth steadily and confidently, without the stress of trying to predict market movements. Look, I get it. Keeping up with the market can feel like a full-time job, but here's the thing. You don't need to be glued to CNBC all day to be a successful investor. What you do need to do is stay informed about the companies you're investing in and the overall market trends. Read industry reports, follow financial news outlets, and don't be afraid to ask questions. The more you know, the better equipped you'll be to make smart investment decisions. And remember, investing is a marathon, not a sprint. It's about making consistent, informed decisions over time. Let's talk about dividends for a second. Dividends are like getting paid to own a piece of a company. When a company makes a profit, they can choose to distribute a portion of those profits to shareholders in the form of dividends. Now, you can choose to take those dividends as cash, which is great. But here's where things get really exciting. You can also choose to reinvest those dividends back into the company. This is where the magic of compounding really starts to work its magic. By reinvesting your dividends, you're buying more shares, which means you'll receive even more dividends in the future. It's like a snowball effect. Over time, even small amounts of money can grow exponentially. So there you have it, 5 smart investing tips to help you grow your wealth steadily over time. Remember, investing is a journey, not a race. It's about making smart, informed decisions that align with your financial goals. If you found these tips helpful, make sure to give this video a thumbs up and hit that subscribe button so you don't miss out on future videos. And as always, keep hustling, and I'll see you in the next one.